Hosted in conjunction with Chris Media, the CEO interview series allows investors to hear directly from the CEOs leading the companies featured on Wholesale Investor. Enjoy the interview and reach out via the details in the description.
Hi and welcome to another crisp Q&A. I'm here today with the Managing Director of Carpe Diem Central Real Estate Trust, Simon Wheatley. Thank you for joining me, Simon.
Thank you very much, Cindy.
Simon, look, just to get started so the audience understands, do you mind telling us the actual investment focus of Carpe Diem, just to begin with?
Sure. So Carpe Diem is a pure play property funds manager. So all we're looking at is investing in direct real estate, typically through sophisticated or wholesale offerings, and then offering that to investors for a medium-term investment period. And then at the end of that period, we'll look to sell the assets as a catalyst to returning the capital back to investors. And in the meantime, up until that catalyst, we're looking at paying attractive dividend yields and focusing on growth within the portfolio for investors.
Excellent. And Simon, just in line with this, can you tell us the overview of the fund as it stands right now, the specifics of it? I
guess stepping back a little, our primary focus for funds within Carpe Diem Partners is twofold. Essentially, we look at long leased real estate, very high quality head tenants on very long-term leases, and wrapping funds around that. And the second style of asset type or fund type that we have is investing into regional accommodation funds and regional accommodation opportunities, so motels, hotels, and resorts in regional locations. So very different styles. I guess in terms of our current offering of the Carpe Diem Essential Retail Trust, it is a vehicle which is going to be owning 14 service stations in the major regional cities of Rockhampton, Mackay and Gladstone primarily, very well diversified across those, and there's no lease expiry on any of those properties until mid-2030. The assets are all backed by the local subsidiary of Chevron, Caltex, so very, very high quality tenant covenant rating behind the assets themselves, and the portfolio has inflationary annual increases in it as well. So we see that as quite topical at the moment when inflation's high. We're actually looking at a 6% rent growth coming through for the whole portfolio this year alone, and obviously rebasing things up with high inflation means that there is opportunity for an inflation hedge with this portfolio.
Simon, what's the unique investment methodology that you employ when it comes to deal discernment and due diligence?
We've got several decades of deep real estate background and experience. My background was running real estate divisions in Goldman Sachs for 16, 17 years. And we've got as I say, a very deep background, and we take the diligence side seriously. And as part of that, we've got a professional team that we employ to work through the diligence with us on every transaction. We do see a lot of transaction opportunities come through that we assess and discard. And we've seen a lot of those over the last 6 or 9 months. As I say, what we do like about this style of asset and this portfolio is the very long-term leases. So our fund will open and be closed. I will sell the assets off before the first lease expiry. And one of the key things we look at in terms of risk is really risk to top line cash flow and what that means for the real estate. In terms of assessing that, we look at office at the moment. Office has always been a core commercial real estate asset class. We're of the view, however, that it's not that attractive at the moment. There's obviously the work from home overlay, meaning that tenants are looking at whether they need the same level of space. There's vacancy rates, which are usually in pretty much every office building. Our portfolio has 0 vacancy rate in it. There's generally tenant incentives that you have to pay up to 30% of the lease as tenant incentives in, say, an office building. And again, our portfolio has zero exposure to or leakage to tenant lease incentives, rent freeze, or fit out contributions. So very, very clean style of investing, very clean style of real estate. All of the outgoings are recoverable from the tenant. So the tenant essentially pays for everything. And as part of that, we have obviously a very clean underlying cash flow for the fund, which we see as a distinct positive.
Excellent. Now you touched on it briefly there, but what are the specifics around the team behind Carpe Diem? Who is the management team, and what skills and experience do they bring to the table?
Yeah, so the two founding partners of Carpe Diem Partners are myself. As I say, I started in commercial valuations with Jones Lang LaSalle, biggest commercial real estate agency in the world, back in the 1990s, and have been in real estate investment banking and equity research in real estate across Australia and the US, heading teams there essentially since 1999, and have since leaving Goldman in 2016. Our business has been mandated on several $1 billion worth of transactions. So we've got a deep level of expertise across a substantial level of or substantial breadth of asset class. The other founding partner is Angus Geddes. He is also the founder and CEO of a group called Fat Profits, which is an equity advisory business with 20 years of track record, and in the order of $200 million of assets under management. And there's several ASX listed funds in amongst his overall fund offering as well. So we've got experience across the listed side, the unlisted side, across equities, across real estate, but very clearly focused on direct real estate opportunities and offering distinct opportunities to investors.
Simon, just a parting question for the audience. What are the current opportunities at play at Carpe Diem at the moment, and what can prospective investors inquire about and get involved in right now?
So our current offering, which will be closing in May, is our Essential Retail Trust. You'll be able to see that in the crisp deal room, but we have, as I say, we're raising $25 million to buy a portfolio of 14 service stations. They're all currently branded Puma at the moment, but will be rebranded to Caltex to reflect the acquisition of Puma by Chevron. So we think that's obviously it's focused on essential services asset class. We see very little risk over the term of the fund from electric vehicles, and in fact, there is numerous forecasts in the market that suggest that the number of petrol vehicles will continue to rise into 2030 before they start to decline. And CSIRO is forecasting that even by 2050, there'll still be the same number of petrol-driven vehicles on the road as there are today, which is 20 million petrol-driven cars. Against that, there'll be a substantial rise, obviously, in electric vehicles. In terms of other offerings, our next fund, post this one, will be our third regional real estate accommodation fund. Our first two funds have been yielding or targeted yields of 10%. Our first one is currently yielding in the order of 12%, so exceeding forecasts and going very well. We've just finalised all of the acquisitions for our Red Hill Regional Accommodation Fund number 2, and we'll be stepping into our third fund. We see a significant opportunity within the regional accommodation market, given it's very fragmented, typically owned by mums and dads, and we can take larger investment opportunities there, buying at double-digit yields, with still significant operational upside as we go in and take charge of those and add our own management overlay to them.
Excellent. Well, Simon, thank you so much for your time today. It was great to hear the ins and outs of the fund and the current opportunities at play. And if anybody would like to reach out further to inquire, I'm sure they can reach out to you, Simon, and we'll have the details of the deal room whereby you can request access and see the information that you need for your process of due diligence. Thank you again, Simon, for joining me today.
Thanks so much, Sydney. Appreciate it.